Hey, Shane.
Diana, welcome back.
It's been a few weeks, and before I went on leave, it all looked quite optimistic. We had a memorandum of understanding or misunderstanding signed between the US and Iran, and it's all turned kaputski in the last few weeks.
Because you went away.
I think so. And we've now seen 11 days of strikes on Iran as we're recording the podcast, and now concerned that even areas in Saudi Arabia might be blocked from accessing oil, and now we've seen oil prices rise. So what's been happening?
Well, it was fun when you went away initially. It was all very calm. And in fact, it's been a nice period in that sense. There hasn't been a lot of economic data or a lot of upset, except the situation with Iran. I mean, one theory is that Iran signed up the peace deal and then was able to get out its ships with oil on. I think they exported 6-7 million barrels of oil or something like that. Quite a lot of oil went out. And then they thought, okay, we've got our oil out now. We've got our reserves down, because if they keep drilling it out of the ground, then it goes into reserves, then eventually it gets full. So we've got all that out. So let's hit some ships again, which they did. They struck some ships going along the Omani coast of the Strait of Hormuz. And then, of course, the US, after that went on for a bit, decided they had to retaliate, which they did. And now the peace deal is gone. The Strait of Hormuz is shut again. Oil prices, as we're speaking, are up, roughly $20 a barrel or something. A little bit more if you look at Brent, a little bit less if you look at West Texas. And the big concern is that, as you say, or implied, that the Houthi rebels will be able to blockade Saudi Arabian oil exports, which they were able to divert through their east-west pipeline that runs from the Persian Gulf to the Red Sea, and therefore stop the loading of oil at Yanbu port, which then comes out through the Bab el-Mandeb Straits into the Gulf of Aden, and then out ultimately into the Indian Ocean. Or alternatively, it goes through the Suez Canal to Europe. But I think a lot of the oil coming from that area was going off to Asia. So we're sort of in some ways back to where we were before, but it could turn out worse because of those diversions across the east-west pipeline in Saudi Arabia and out through the Red Sea, and then likewise the UAE's pipeline that goes to Fujairah, if I've pronounced that correctly. The hit to global oil supplies was a lot less than 20 million barrels that normally goes through the Strait of Hormuz. It was more like 12 million barrels, and the global economies have been able to run down reserves. But the problem on that front is that if the bypasses are now stopped or made more problematic, that's an issue. And not only that, we're getting lower levels of reserves globally. I mean, some numbers that me, Boo and I were looking at last week when you were away suggest that global reserves are still okay, but they are running down.
Yeah. So it feels like there's more constraints now than there was when the conflict first started in March, April, because we have run down reserves a lot more, and we are getting closer to the US midterm elections. I mean, I don't even know if those are really a constraint on Trump anymore, because the Republicans were expected to lose seats, but it does look like maybe they'll lose more because gasoline prices have increased so much in the US, and most people were supportive of a peace deal that was signed. So now that the peace deal is no longer there, surely people would be a bit unhappy with him, and his voter popularity rating has fallen to a record low again.
Well, you'd think so. I mean, surveys I've show something like only 60% of Americans, so 60% of Americans don't support the war. So it was an unpopular war, and the options for Trump, I think, are really difficult. Like, he's between a rock and a hard place. If he just gives in to Iran, then they take over the Strait of Hormuz, and that will be his legacy, which wouldn't be a very good one. If alternatively...
But they already control it.
They do now, but they didn't before the war.
But they were the ones that initially stopped the vessels from getting through. So, I mean, technically it was always a risk. It's just never happened before. Like, they were always the ones that had the upper hand in that region. I don't think
Trump saw it that way. Otherwise, they wouldn't have started the war. I mean, my understanding is that the advice he was given was that they couldn't block the Strait of Hormuz, and some advice was given to him that they would do that, but he ignored that advice. And then that's why he's in such a difficult situation now, because it wasn't blocked up until February the 27th, and then from that point onwards it has been blocked, but only because the war started. So they've got more power than perhaps he assumed that they would have. So either he can back down and they've got control of the Strait of Hormuz, not a good look for a US president's legacy, or alternatively he goes after them, tries to stop their ability to block it, and their nuclear capabilities as well. But that could require troops on the ground or a lot more loss of life than Trump's prepared to accept, and much higher oil prices and gasoline prices in the interim. So it's a really difficult situation, I think, for the US now.
And a risk that we go into this prolonged forever war again, which people wouldn't really support in the US.
Yeah, I don't think they would. And so I think ultimately Trump, and this is just personal view, I think he probably has to back down at some point. Because even though he's going to lose, the Republicans will lose the House congressional election. So there's the House. It's almost inevitable they're going to lose that. That's the history of midterm elections. The president's party loses the House. The Senate is the one that's up in the air. And if they lose that as well, most of the betting markets thought they would. Now it's sort of swung back to, no, they'll keep it. Now with the war starting again, maybe it's swinging back to the view that they'll lose it. That would be a really big blow to the Republicans if they lose the House and the Senate.
Yeah.
Because it opens up more inquiries, takes Trump's power away.
Yeah, he could be impeached again.
He could be impeached.
And he's spoken about that before, that he doesn't want to lose both the House and the Senate because the risk of impeachment is so high.
Yeah, it is. And depending on how many seats the Democrats might win in the Senate, you might just find a few Republicans who would actually vote for impeachment to get you I think you've got to get a certain majority or something. So that is a risk that he faces. That's why I kind of lean to the view that he'll probably back down again. But then the question is, if he does back down and announces another TACO peace deal, is that going to be durable? What happens after the midterms? Does it all flare up again?
And I think that this sort of volatile period explains why shares haven't really done anything the past few weeks. They've sort of been around record highs still, but they haven't really been able to trend up. But the other part of the story is, of course, what's happening in the tech sector. We've seen some concern that, there's always this prolonged concern that tech is overvalued, that we're in a bubble, that it's all going to come crashing down. But we've seen a bit more of that lately. Yeah. The Korean stock market is down by 20 or 25% from its high, when a lot of that, as we've spoken about in other podcasts recently with Mi Bui, a lot of that is down to the semiconductor space, which is sort of the hardware or the infrastructure behind tech.
Heavily exposed to semis.
It's mainly two companies, Samsung and SK Hynix, which make memory chips or semiconductor chips, which is the infrastructure that's required for tech. But in the US now too, there's this concern that some of the other tech names like Nvidia, which is another big chip maker, that profit growth is going to be a bit softer. But we are in the middle of reporting season now in the US.
It may well be that we're just going through we went through a bout of nerves ahead of the earnings reports. And if the earnings reports are okay, then the market will breathe a sigh of relief and then off to the races again.
The tech earnings are still up by 30% year on year or so?
30 or 40 or something. And the consensus for earnings growth this reporting season, so this is for the June quarter, on a year ago, the consensus is something like 24, 25%.
So it's still very high.
It's still very high. It's down slightly from 29, which was a shoot the lights out result in the March quarter, but still pretty good. And there's a bit of debate here. You can have the bears are saying the markets are overvalued, that earnings margins are not sustainable, that the data boom will end up being a lot of wasted investment, like some of the investment that occurred in the tech boom, whereas the bulls are saying, well, there's still a shortage of computing power. AI story has a long way to go yet. When you adjust for that, the valuations aren't too bad. And that, hey, bears, you were saying something similar a year ago, but a year ago you were focused on economic fundamentals and they turned out to be okay. So why should we get so worried about what you're saying now?
I think at the end of the day, it all still looks pretty good on the tech front. We still need to see more AI adoption across the space. There's more investment that's going in. There's more CapEx that's going to be spent next year. The hyperscalers are going to spend about $1 trillion on CapEx in the US next year. That's like double where we were last year. So I think that there's still more profit growth to come. And my personal view is that we're just going through a bit of a short-term disruption in terms of profit growth. But I think that we need to see the resolution in the war for stocks to really get another leg up. But the economic data has actually been pretty good in the past few weeks. The inflation figures around the world have been all right, despite the fact that oil prices have been so high. We get an update on inflation in Australia. Maybe we don't look so good. And the New Zealand data this week wasn't particularly optimistic on the inflation front. looks like the Reserve Bank of New Zealand's going to have to hike rates again. But in the US, at least, inflation hasn't been as high as it was feared to be.
That's true. I mean, so far we've got the June CPI numbers, and they were headline number was a slight negative in the month. But the core rate, which is what the central banks focus on, excluding energy and food, was actually down slightly. So that's why the market was kind of happy. I think it was 0 in the month, and the annual rate fell slightly, and that provides confidence that the next reading for the what they call the core PCE, core private final consumption deflator. But believe it or not, most countries just focus on the CPI. In the US, the Fed focuses on this private final consumption deflator because I think there's an argument that it's re-weighted more regularly. But it was running around 3.4% in May. There's a view that it'll fall to 3.3%, and that gives the Fed some scope to hold. But the funny thing is that data doesn't come out till the Fed meets in the week ahead.
Yeah.
So the Fed meets on the Tuesday and the Wednesday, I think it is, and then the key inflation data comes out on the Thursday. But they would probably say, well, we've got enough at present to say we won't hike rates in July. But the message we did seem to be getting from the Fed was that there's a lot of Fed presidents and some governors who are losing a bit of patience with inflation, that if it doesn't sustainably show signs of going down, then they're sort of inclined to hike rates.
And the market gets spooked when there's talk about rate hikes, particularly in the US, given that we were expecting rate cuts to occur this year.
That's right. I mean, it's odd in a way. Trump's got his guy in the Fed, and all the debate is about whether they'll hike or not. Whereas before, under Powell, there was more talk about whether there'll be cuts. But I think that just reflects the flow of the data. The data has turned out worse. And if you're a Fed official, you'd say, okay, well, maybe the worst from the tariffs were over. But
not anymore after this week's news.
Maybe not, because he's just putting more tariffs on. Now the war's starting up again, so that means an increase in gasoline prices with a flow on to other prices. And then all this AI spending leads to slightly higher inflation.
I mean, on the tariffs, we've had more announcements on that. 100% tariff on pharmaceutical prices, but only starting from August 2028.
So that may not happen.
Yeah, I think it's just way too far away. Plus, it also is reliant on companies not investing into US pharmaceutical industry. So if you invest, you can bypass the tariffs, but it's just so far away that there's going to be carve-outs and changes.
But what about what is it on Canada? Was that 50?
Canada's a 50% tariff on about...
So this is all because they've got bushfires, they call wildfires, blowing across American cities. Trump gets all agitated at the FIFA World Cup final with Carney and then puts this tariff on them.
Yeah. So I calculated that the 50% tariff on Canada should add about 2.5 percentage points to average US tariff rate. But I think a lot of those goods will move from, if they're not included in the US MCA free trade agreement, they'll move to be compliant in that agreement. So I think effectively the tariff increase won't really be that high because there'll be changes to how goods are classified under US MCA, which is the free trade agreement between the US and Canada. So I don't know if these tariff announcements really increase the effective US tariff rate that much. It still seems to be oscillating between 10 and 12%, way below the 30% that Trump wanted at the Liberation Day rates of tariffs. So that key policy pillar for him has not worked out as they intended, which was to reduce the budget deficit and to bring in more government revenue.
But there's two issues here. Back in February, the Supreme Court ruled illegal Trump's reciprocal tariffs. Then he put these other 10% tariffs on under Section 122 of a Trade Act, which expire this coming Friday. So we're recording this on the Wednesday. On the Friday, July 24th, those tariffs expire, but they're going to be replaced by forced labour tariffs, and when you look at the map of the world, virtually every country is accused of forced labour. Or not having enough restrictions on imports into their country from countries that might be using forced labour.
So are the new forced labour tariffs permanent?
Well, my understanding is they would be. So the Section 122 10% tariffs, that was only temporary up for 150 days, expires July 24th, so that's this coming Friday. We might have passed Friday by the time you're listening to this. Then he would have these Section 301 forced labour tariffs, and then there was some other tariffs under another section. It could have still been 301, I've forgotten the precise number, which would be aimed at countries that have according to the US Trade Representative, chronic excess capacity. So presumably China and Europe and others. Now, hopefully Australia escapes that, but it looks like we will get hit with forced labour tariffs. And the debate there was whether we get the 10% or the 12%.
So whichever way you look at it, tariffs are still going to be higher than where they would have been before Trump, but not as high as he would have liked.
Not as high as he would have liked. And I kind of think, well, because it's not as high as he would have liked and only 2 countries actually responded to his trade war. Most countries said, we'll take the high road. You know, if you want to put tariffs on your own citizens' consumption goods when you import from us, that's your problem. We're not going to tariff our own citizens. So if I import a car from the US, then I don't have to pay a tariff on it. But that I think was a sensible response. But 2 countries, Canada and China, did retaliate. But I think basically because you didn't have this broad-based trade war, that's why last year's fears didn't really come to pass. And the numbers back, rather than 30%, we were back down to around 10% or something like that. It's still a concern. I would argue, because I'm a free trader, that we're better off with free trade and globalisation ultimately, and that the world economy and Australia have benefited from that because we get cheaper goods and it's helped keep inflation down, keep interest rates down. Now that's all going in reverse. But the trouble is that when you start putting tariffs on it, the negative impact only shows up over many years. Yeah. It's a bit like Brexit.
Well, we have seen some impact. I mean, the inflation rate's been 0.5 or 0.7 percentage points higher in the US. But anyways, so, I mean, the outlook for share markets is still flat to slightly down given the risks in the near term. The war is still ongoing. Oil prices are up. The economic data might soften a little bit with higher prices, and markets are a bit nervous about tech still. So in the short term, hard to see a decent rally.
Yeah, it's a bit hard. I don't know, I'm sort of mixed about it. I mean, I always get worried when we come into August, September because seasonally they were soft months. So there is some vulnerability there. Flip side, I guess, is that the underlying earnings story is positive. And usually when earnings are still going up, that's positive for the share market. So that's why I'm a bit unsure about the short term, but I think on a 12-month view, shares still do okay. Obviously a lot riding on what goes on in the Middle East and so on, but I think ultimately it turns out okay. And yeah, things are not great. And we've got this constant noise in Australia about falling living standards. And as we were discussing last time you and I were on a podcast together, things are better, far better than they were, when I was a kid, materially. But yeah, those sort of concerns are still there, mainly because of short-term issues. But if you look at the economy, it's still growing in Australia. Unemployment is still relatively low, and even though interest rates may still go up again, we're thinking they'll probably go up once more or twice more. In a great historical context, they're still relatively low.
Yes, we need to get some perspective sometimes. But it's hard to remember what your living standards were like 20 years ago.
Well, yeah, there's a natural tendency to look back, and you look back to a time when you were young and fit and healthy and whatever it was, and you think, oh, they were the best times. I know my mother, if I ask when were the best times, she'll tell me the 1950s. And I will, when was the best time for you, Shane? Oh, well, the 1980s or something. But in the great scheme of things, if you look at it from a material point of view, as we were trying to point out in that last podcast, material conditions are actually better today than they were back then.
They were. Okay, Shane, we'll see you next time.
Thanks, Diana. We sure will.